Welcome back to The Deep Dive. Today we are taking a massive run-up to tackle a truly unique and frankly historically significant pile of source material. We're focused on a company that has undergone a corporate transformation so dramatic it almost sounds like fiction. Nebius Group N.V, trading under the ticker NBIS.
It really is an incredible story.
Let me give you the hook right up front, because the conclusion drawn in this research is utterly compelling. How exactly did a company that was forced to undergo a radical, painful geopolitical fracture, shedding the bulk of its massive legacy business, emerge on the other side with nearly $5 billion in cold, hard cash on its balance sheet?
And not just the cash.
Not just the cash, and staggering multi-billion-dollar AI infrastructure contracts secured with giants like Microsoft and Meta. This is not just a paradox. It's a financial engineering miracle. Our analysis suggests this stock is currently trading at a significant discount, implying the intrinsic value is potentially 33% higher than the current price. We need to know precisely how they pulled this off and, why the market still hasn't fully registered this new reality.
That gap, that disconnect between the asset quality and the market price, that is the core of our mission today.
Exactly.
We are here to unpack this intricate corporate engineering feat. We need to dissect Nebius's transformation from its former life as Yandex N.V, once known as the Google of Russia, into what the research compellingly calls an AI utility. It's poised right at the absolute center of the AI compute supercycle. So we are specifically determining if this immense high-stakes asset restructuring the separation of clean global intellectual property from severe geopolitical risk offers a genuine, demonstrable margin of safety for the value investor.
And what makes this deep dive so complex and so rewarding is that this is not a simple linear business story. We're not just looking at quarterly growth rates.
No, not at all.
This is a case study in high-stakes corporate agility, capital preservation under duress, and most importantly, the ultimate portability of human capital and technical IP in the 21st century. We have to peel back the layers of history, finance, geopolitics, and deep technology all at once.
It's a lot to unpack. So to manage that complexity and provide you, the listener, with a structured roadmap, we've organized our entire deep dive using the 7-chapter framework established in the core research report. We'll move sequentially, building the case piece by piece, starting with the new business model, flowing through management and financials, before addressing market sentiment, ownership dynamics, and concluding with a thorough risk and valuation assessment that underwrites that potential 33% upside.
Okay, I'm ready. Let's jump right in and start building the foundation.
Part 1, chapters 1 to 3, business, management, and financials.
Chapter 1, business understanding. Okay, let's unpack this core concept, Nebius as an AI utility. That term suggests something foundational, essential, almost infrastructure-like, similar to electricity or water. Are we really talking about a provider of the essential raw material compute power for what people are calling the fourth industrial revolution?
That is precisely the framework. The investment thesis itself, which the analysts adopted, uses what they call a Buffett-oriented perspective.
Okay.
The ideal investment here is acquiring high-quality assets at a substantial discount, assets managed by an owner-operator with aligned interest. Classic Buffett.
Right.
The challenge is that Nebius operates in the extraordinarily capital-intensive domain of AI infrastructure, rather than a consumer-facing monopoly. But the utility parallel holds because they provide a non-discretionary, scarce resource that powers everything else. Their high-performance computing, or HPC, capacity is quite literally the energy required for the entire modern AI boom. Without that capacity, large language models cannot be trained or run. It's that simple.
To understand how Nebius secured this massive competitive advantage, this massive pile of assets and cash, we have to start with the dramatic corporate history, the genesis of Nebius, the Great Separation. This wasn't a gentle spin-off. This was crisis-driven surgery to save the patient.
That is the absolute foundation of the thesis. For nearly 2 decades, Yandex N.V was a technological behemoth, the undisputed Google of Russia, dominating search, taxi services, e-commerce, you name it, across a massive geography.
A giant.
A giant. However, the immediate aftermath of the 2022 geopolitical crisis made it completely untenable for a Western-listed, Dutch-domiciled public company to operate such a regionally focused, high-profile business.
Right, they were stuck.
Completely.
Yeah.
The management and board were essentially forced to engineer a complex, multi-year divestment strategy to surgically separate the internationally focused IP and assets, the parts that could thrive globally, from the regional sanctioned vulnerable operations.
And the execution of this separation was nothing short of staggering. The sources detail how this culminated in mid-2024 with the sale of the Russia-based businesses to a local consortium. What's the price tag on escaping a geopolitical trap?
Approximately $5.2 billion in cash and Chinese yuan.
Wow.
That transaction is the sole source of the fortress balance sheet we'll discuss later. But what makes this a deep dive, and not just an M&A history lesson, is appreciating the magnitude of the corporate tightrope walk.
I mean, the risks must have been enormous.
Oh, astronomical.
Yeah.
They managed to negotiate the sale, secure the capital, and transfer control without violating any international sanctions or destroying the underlying commercial value. That required legal and financial finesse at the very highest level.
But the research is clear. What Nebius Group N.V. retained, the assets that form the Amsterdam headquartered core are arguably more valuable than the cash itself because they represent the IP and the future.
Precisely. They retain 4 key international business lines. First, the foundational core, Nebius AI, which is a cloud infrastructure and GPU hosting business.
The main engine.
The main engine. Second, Avred, their surprisingly advanced autonomous driving division. Third, Triple10, their global edtech platform. And finally, Toloka, the data labeling and AI training platform. These 4 pillars are clean, global, and fully transferable.
But the actual masterstroke, the secret sauce, wasn't just retaining the business lines, it was the human capital. The sources specifically mentioned that Nebius retained and successfully relocated over 1,000 top-tier engineers.
To new hubs in Amsterdam, Tel Aviv, and Belgrade.
That is the definition of value that doesn't show up on a traditional balance sheet.
It's the ultimate head start, or perhaps the ultimate moat. This human capital flight means Nebius didn't have to start a new cloud business from zero. They inherited a mature, proven, high-performance engineering culture, one that knows how to build and scale hyperscale systems.
Right.
Host, think about the cost and time involved. To replicate that capability today, for a new entrant, would take a decade of recruiting in the most competitive labor market in history and cost billions in salaries, golden handcuffs, and retention bonuses.
Impossible.
Nebius got it baked into the operating engine.
So if they have the talent, what is their primary economic moat of scarcity and time? What prevents Amazon or Google, with their, infinite capital, from just deciding to swallow them whole by offering more capacity?
It comes down to a fundamental supply bottleneck that money alone cannot solve quickly. The scarcity of ready-to-deploy high-performance computing capacity, especially cutting-edge GPU clusters like the NVIDIA H100s.
Right, the chips everyone wants.
Exactly. We are in late 2025, and the demand for large-scale AI training and inference continues to outstrip supply dramatically. There are bottlenecks everywhere, not just in chip manufacturing, but in physical data center construction and, critically, power access. Nebius has inventory and capacity that is operational and ready to go today.
And that scarcity, that inventory, is exactly what validates their entire pivot. The massive recent contracts with Microsoft and Meta turn that speculative, theoretical capacity into guaranteed, revenue-generating, utility-like assets.
Absolutely correct. These contracts transform capacity into contracted, recurring revenue streams, and the source material even compares holding this business to holding high-grade utility bonds.
That's a strong comparison.
It is. The risk profile shifts overnight. Once you have capacity pre-sold for 5 years to AAA-rated counterparties, Microsoft and Meta, it is no longer a risky growth story. It's an infrastructure story with profound revenue visibility and predictability.
Zooming out slightly, let's look at the macro environment and constraints. We know about the AI compute supercycle insatiable demand driven by LLMs, but you mentioned a new, often overlooked bottleneck that Nebius has strategically addressed, which is now perhaps more critical than the chip supply itself.
Yes, the primary constraint has shifted in many key markets from the NVIDIA chips to power.
Just electricity.
Just raw power. Data centers are astronomically power hungry. Securing reliable, massive grid connections in primary, highly regulated markets like Northern Virginia, Frankfurt, or London faces multi-year backlogs due to permitting and grid upgrades.
So you can have the hardware, but nowhere to plug it in.
Exactly. You can buy all the GPUs in the world, but if you can't plug them in, they are worthless.
So Nebius' strategic foresight in securing power capacity ahead of this trend becomes a critical valuation driver, moving them from a tech company to an infrastructure landlord. Tell us more about those specific sites mentioned in the research.
The research highlights 2 key strategic locations. First, the flagship facility is in Mentholi, Finland. This site benefits from low-cost, green Nordic energy and naturally efficient cooling, which dramatically lowers the total cost of ownership, the TCO, compared to competitors.
Okay, that makes sense. Cheaper to run.
Much cheaper. Second, the strategic new site in Vineland, New Jersey. This places capacity close to the U.S. East Coast financial and tech hubs, critical for low-latency financial AI or high-speed foundation model training. The key takeaway, which must stick with the listener, is this. In a power-constrained world, a pre-secured megawatt in hand is highly valuable, and Nebius secured this capacity well ahead of the curve, effectively buying an option on future growth.
Now, let's address one of the most intriguing elements in the analysis. The discussion of the potential 2025 geopolitical shock, the proposed 100% U.S. tariff on semiconductor imports. Usually, tariffs are bad news for companies with high capex needs. Why does this research frame it as a paradox that might actually benefit Nebius?
This is where it gets really interesting and why we need to elaborate on the mechanism. If the U.S. implements a 100% tariff on certain imported semiconductors, the components Nebius needs for expansion, it would immediately raise the cost of future capex by up to 75% for all U.S.-based operations.
Okay, so that hurts them on future builds.
Yes, it is detrimental to future expansion plans for everyone. However, for Nebius, it paradoxically increases the replacement value of their already deployed or repaid for existing fleet and infrastructure.
Ah, I see. So it's like their existing inventory just got a massive valuation markup and their moat just widened significantly against new competition.
Exactly. Imagine you are a small competitor trying to enter the market. Your hardware costs just instantly jump 75%. You cannot compete on price or scale with a capitalized incumbent like Nebius, who is effectively sitting on inventory purchased at the old price.
It's a huge barrier to entry.
It prices new competitors out of the market entirely, allowing incumbents with strong balance sheets to consolidate market share. Furthermore, because Nebius's footprint is global, their European facility in Finland offers a partial hedge, allowing them to service non-U.S. clients without the immediate tariff burden.
So a policy designed to slow one thing down ends up reinforcing the power of another.
The tariff, designed perhaps to slow Chinese expansion, ends up reinforcing the scarcity moat for capitalized, Western-focused incumbents like Nebius. Chapter 2. Management Evaluation.
We've established the quality and scarcity of the assets, the horse, which are exceptional. Now, we shift focus to the quality of the leadership, the jockey, the management team steering this incredibly complex pivot. After surviving a corporate near-death experience, the stakes for this team are astronomical.
They are. And the fundamental strength of the leadership is rooted in the owner-operator alignment provided by Arkady Veloz, the founder of Yandex, who is leading the new entity.
Right.
His substantial equity stake, approximately 12%, ensures his interests are directly and overwhelmingly aligned with minority shareholders. This alignment is foundational for the entire value thesis.
The sources refer to this transformation as Veloz's redemption arc. That sounds great for a Hollywood script, but is there any real evidence this isn't just PR? Are his incentives truly long-term, or could he still be looking to maximize short-term value to recover some of his previous losses?
That's a crucial challenge we must address. The narrative of the redemption arc is powerful because it addresses motive. Having lost control of his original empire and suffering a massive hit to his personal fortune and reputation due to circumstances largely beyond his control.
Right, a huge blow.
The only way for him to fully restore both is through the long-term sustained success of Nebius. This isn't about maximizing next quarter's bonus, it's about rebuilding a legacy.
So his only path forward is making this a huge success.
Exactly. His path to restitution lies entirely in Nebius becoming a multi-decade infrastructure giant. That translates into a long-term compounding mindset, which is precisely what value investors seek.
And success in this hyper-competitive sector requires more than just financial savvy. It requires deep technical expertise. They are competing directly with the biggest tech companies on Earth. Do the sources suggest Veloz has the necessary vision and technical acumen to lead an AI infrastructure company?
Absolutely. He is positioned as a classic, visionary product guy. His historical track record at Yandex speaks volumes. His early prescient bets on complex fields like search, mapping, taxi services, and self-driving were all successful and technically demanding.
And all required huge infrastructure.
They all required massive infrastructure build-out. That historical success lends immense credibility to his current massive bet on AI infrastructure being the next great wave. In a company where infrastructure performance, latency, cooling, network efficiency dictates market share, having a CEO who genuinely understands InfiniBand architecture and GPU utilization is non-negotiable.
Let's discuss the governance and board competency. We mentioned the crisis management involved in the divestment. Running a growth company is one thing, but managing a total corporate overhaul under extreme geopolitical duress is another entirely.
It's a different league. The board of directors, which features experienced professionals like John Boynton and Charles Ryan, demonstrated their primary competency in that precise moment of crisis. Their ability to navigate the legal and financial complexities of the divestment process, separating assets, preserving billions in shareholder value, and ensuring continuous operations while avoiding international sanctions was, as we said, a tightrope walk. That speaks to a level of operational and governance competency far exceeding a typical tech board. The smooth transition to the Dutch domicile and NASDAQ listing confirms a structure designed for global market credibility.
Finally, a detailed look at the capital allocation history is vital. Are they showing discipline regarding return on invested capital or ROIC, or are they just, splurging that $5 billion in cash?
They appear highly disciplined. The management's history at Yandex, and now at Nebius, focuses heavily on organic growth, building their own state-of-the-art data centers and clusters versus expensive, speculative M&A.
So they build, not buy.
They build. It shows a healthy respect for ROIC. They aren't trying to buy growth at a premium. Furthermore, the record shows them being opportunistic in managing the capital structure, using share buybacks when the stock was undervalued, and issuing strategically timed convertible notes in September 2025. This indicates a management team actively stewarding capital to support fully funded, disciplined growth without unnecessary dilution. Chapter 3.
Now for the numbers. This is where the story of the pivot really explodes onto the income statement. Based on Q3 2025 results, we are looking at a company in a violent upward inflection.
The revenue dynamics are genuinely massive. Let's start with the headline numbers. Q3 2025 revenue was $146.1 million, which is up a stunning 355% year over year.
355%.
But focusing purely on the core asset,
Yeah.
the AI infrastructure segment, the growth was even faster, clocking in at 400%. This is definitive proof that the pivot is working and the market is validating their HPC capacity.
That current run rate is around $600 million annually, which is impressive, but that Microsoft deal completely changes the scale. It's an order of magnitude shift.
It changes the entire financial paradigm, which is why the market hasn't fully digested this yet. The $600 million run rate is essentially derived from backward-looking spot market sales and smaller contracts.
Right.
The Microsoft deal alone is structured for approximately $19.4 billion over 5 years, translating to an average of about $3.8 billion per year.
So when that kicks in,
When that deal fully ramps up in 2026, the company's revenue is projected to jump to potentially $3 to $4 billion. We're looking at a company transitioning almost overnight from a high-growth, small-cap structure to a multi-billion-dollar infrastructure giant with revenue visibility for half a decade.
this massive growth and required capex needs a rock-solid foundation, which brings us to the fortress balance sheet and liquidity. This $4.8 billion cash position is the ultimate downside protection, right?
It is the single biggest factor mitigating investor risk. Following the massive divestment, Nebius reported cash and cash equivalents of nearly $4.8 billion as of September 30, 2025. For a company undertaking massive infrastructure build-outs, this liquidity eliminates external financing dependence, which is extraordinary.
Okay, but we have to address the debt context because the sources cite around $4.1 billion in long-term debt. For a non-financial investor, that looks intimidating next to $4.8 billion in cash.
Context is absolutely vital here, and this addresses the critique about clarifying financial jargon. When you look deeper into the composition of that debt, a significant portion, the majority, is not high-interest corporate bonds used to finance operations. It is composed of lease liabilities for the physical data center shells.
Ah, so it's what they call capitalized operating leases?
Exactly. In plain terms, when Nebius leases a massive data center facility for 20 years, the accounting rules require that the entire present value of those future lease payments be shown on the balance sheet as long-term debt and a corresponding asset.
So it's debt in name, but it's essentially prepaid rent for their infrastructure assets, which are already covered by contracts. It's less risky than traditional bank loans or junk bonds.
Exactly. It funds their physical footprint in a low-risk manner. When you net the $4.8 billion in cash against the operational and project debt, the net debt position is roughly neutral or even slightly negative.
Wow.
This is a phenomenal capital structure for an infrastructure firm that is currently in a massive expansion phase where competitors are often carrying heavy, unsecured leverage.
Let's discuss the path to profitability, looking at the profitability profile and the J-curve. Where are they financially right now?
They are precisely at the inflection point, moving from the bottom of the J to the steep upward swing.
Okay.
The most critical metric in Q3 2025 was the adjusted EBITDA loss, which narrowed dramatically to just $5.2 million. This is down from a much larger $45.9 million loss in Q3 2024. This shows definitively that revenue growth is finally outpacing fixed operating costs.
Explain that J-curve mechanism to us. How does the profitability profile change so violently now that they're deploying the assets?
The J-curve reflects the nature of infrastructure build-out. The initial phase, the drop of the J, involved massive spending, CapEx on GPUs, data center fit-out, securing power, and hiring the necessary personnel throughout 2024 and early 2025.
All the upfront cost.
All of it. These are all high fixed costs incurred before revenue starts flowing. The magic happens now. As those assets go live, become billable, and utilization rates climb quickly toward 90% and above, driven by those anchor contracts, every new dollar of revenue drops almost straight to the bottom line because the fixed costs are already paid.
So margins explode.
Gross margins will expand significantly, creating the dramatic rise of the J-curve, which leads to explosive profitability in the near future.
That makes the capital expenditures, the CapEx, sustainable, despite being a high-cost business building massive new sites in Vineland, New Jersey and Metsala, Finland.
Sustainability is the key word. CapEx is indeed high, but the crucial mitigating factor is that Nebius is fully funded for its current roadmap. The $4.8 billion in cash, combined with the ability to leverage the pre-sold Microsoft contract for specific project financing, means they do not have to rely on volatile equity markets.
No need to go cap in hand to investors.
None at all. They have the funds and the guaranteed revenue streams to execute their build-out, mitigating the risk of needing to raise equity at depressed prices.
This sounds like a perfect place for a quick break. If you are finding this deep dive insightful, make sure to like and subscribe to Stock Analytics AI.
And for those who want to turn insight into comprehensive knowledge, remember that for $4.99 a month, you get 500+ deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. We provide the shortcut to being well-informed. Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
We transition now to how the market is reacting to this transformed entity, starting with the massive strategic validation provided by the anchor contracts. These deals, valued in the billions, fundamentally changed the thesis from speculative growth to contracted cash flow.
They are the centerpiece of the investment case. Let's detail the financial and strategic logic behind the two landmark deals. We start with the Microsoft partnership, a framework agreement valued at up to $19.4 billion over 5 years.
That is simply massive. Why would Microsoft, one of the world's largest companies and owner of the Azure cloud, sign a deal of this size with a relatively smaller new player like Nebius?
The simple explanation is the compute shortage itself, combined with superior technical specifications and location.
So they just need the capacity?
Desperately. Microsoft's internal demand for compute power, primarily to service their commitments to OpenAI, their Copilot ecosystem, and their massive internal research, exceeds Azure's capacity and the speed at which Azure can build out new capacity. Nebius offered immediate high-quality, high-performance capacity in a strategic location, specifically the Vineland, New Jersey site, which is vital for U.S. latency requirements and reducing the overall dependency on a single internal source.
And what are the profound implications for Nebius?
They are multifaceted. First, the deal provides a massive guaranteed revenue floor for half a decade, underwriting Nebius's entire expansion plan. Second, it drastically de-risks their CapEx spend. A $19.4 billion contract is collateral. Banks are immensely willing to finance the data center assets when they are pre-sold to a AAA-rated client like Microsoft. This leveraging ability is how Nebius can execute its aggressive expansion plan without diluting shareholders.
Following that, they signed the Meta Platforms agreement, approximately $3 billion over 5 years. What does the Meta contract add beyond just revenue?
It adds crucial diversification and technical validation. First, it immediately reduces customer concentration risk. Nebius isn't just relying on one giant. Second, Meta is known for having some of the most rigorous and demanding engineering standards on the planet, particularly focused on open source efficiency, like their Llama stack.
So it's a huge stamp of approval.
An enormous technical stamp of approval on Nebius's architecture, it tells the market. This cloud is not only large, it is technically sound enough for the world's most sophisticated AI users.
Together, these contracts create a stunning revenue backlog.
Indeed. When you aggregate the numbers, the research highlights that these contracts alone imply a revenue backlog that exceeds nearly 80% of the company's current $24.9 billion market capitalization over the next 5 years.
Let me repeat that. The booked revenue is almost 80% of the current market cap.
To have future revenue already booked that is nearly equal to your current valuation is an incredible margin of safety, transforming the investment profile into something highly unique in the vital tech sector.
Moving into competitive analysis, where does Nebius stand? We keep hearing about the Goldilocks zone differentiation. How do they compete with the AWS, Azure, and Googles of the world?
Their strength is hyper-focus. Unlike the hyperscalers who must manage hundreds of different services, Nebius focuses on one thing: providing the most efficient, high-performance environment possible for AI workloads.
How do they do that?
They achieve this through full-stack engineering, designing their own racks, managing specialized cooling, and developing their own orchestration software. They control the entire environment.
Let's elaborate on the key technical advantage cited. The bare metal access. The 5–10% performance gain is critical, but we need to explain why that matters so much to an AI researcher.
This is a crucial distinction for the deep dive listener. When large hyperscalers like AWS or Azure rent you compute power, they typically use virtualization layer as software that allows multiple tenants to share the same physical server efficiently.
Okay, so it's like a shared workspace.
Exactly. Think of it like renting a shared office space in a massive building. You get great amenities, but sometimes the elevator is slow or the Wi-Fi is patchy, that's the performance penalty, or jitter. That jitter can introduce an overhead of 5% to 10% of performance or inconsistent latency.
And for a scientist running a multi-million-dollar months-long AI training workload,
That 5–10% performance penalty is intolerable. If your training run costs $10 million and takes 90 days, that penalty is a wasted $1 million and several weeks of lost time, pushing you behind competitors.
so bare metal is like having the whole factory to yourself.
Precisely. Nebius offers bare metal instances. Imagine renting your own dedicated, optimized factory floor, not just an office cubicle. There's no virtualization overhead, no jitter. This offers the raw, maximum high-performance capability that performance-sensitive AI labs demand. This is the difference between an AI model training in 60 days versus 90 days, and that timing is market share.
And compared to other specialized, smaller clouds like CoreWeave or Applied Digital.
Nebius stands apart due to a clean balance sheet and a more mature software stack. CoreWeave is highly levered, relying heavily on debt financing to buy their GPUs. Applied Digital, or APLD, is largely a real estate and power acquisition play that is trying to pivot into cloud hosting.
Right.
Nebius, due to its history, is fundamentally a deep tech company that inherited a mature enterprise-grade cloud platform built by those 1,000-plus top engineers, making its software stack superior to most greenfield specialized competitors.
Finally, let's look at the technical analysis and market view. The sources suggest the price is consolidating after a volatile run.
It is. The stock price is currently consolidating between $95 and $100, digesting a dramatic run-up where it gained over 200% year-to-date once the divestment finalized and the contract announcements hit.
So the market is taking a breath.
It suggests the market is pausing to fully integrate the scale and implications of the recent contracts.
But the analyst consensus seems unanimously bullish, pointing towards significant upside.
Indeed. The average analyst price target is around $150 per share, implying approximately 50% upside from current levels.
And what about the short interest?
We need to note the high short interest, standing at a significant 12% of the total float. This signifies lingering skepticism, almost certainly tied to the lingering historical Russian overhang and the perceived corporate complexity.
But that creates another potential catalyst.
It does. This high short position also sets the stage for a potential short squeeze if positive news, like a strong earnings beat in 2026 as the contracts ramp up, forces those shorts to cover their positions rapidly, driving the price up violently. Chapter 5. Ownership Structure.
This chapter focuses on the embedded value and optionality that the market might be ignoring, assigning little or no value to. We know about the owner-operator stake of Arkady Veloz at 12%, ensuring alignment. Now let's dive into the hidden assets and optionality, the venture portfolio.
These non-core assets are fully consolidated in the financials, but are frequently valued at zero by skeptical public market investors. This provides a clear avenue for unexpected upside. The first is Afride, the autonomous driving division. This is not a typical vaporware startup.
What makes Afride a serious contender, and how does it contribute tangible value to Nebius?
Its operational history and unique capabilities. Afride has fleets of operational robotaxis and delivery robots, backed by millions of miles of real-world testing.
Okay.
Crucially, that testing includes extremely difficult, often ignored conditions like harsh Russian winter weather, snow, ice, low visibility. This technical capability immediately differentiates them from most U.S.-centric autonomous platforms that primarily test in perpetual sunshine, like Phoenix or California.
That's a huge data advantage.
It is. They also develop their own LiDAR and compute stack, meaning they own the entire vertical.
And what's their more immediate commercial path to revenue while the robotaxi regulatory landscape remains constrained and slow?
The immediate path is logistics. Their delivery robots, or rovers, are commercially viable for fixed-route, last-mile logistics, think campus delivery or food services.
Well, I've seen those around.
The unit economics for these robots are rapidly improving, especially as human labor costs increase, offering a faster, lower-risk path to revenue realization. The analysis suggests that even a conservative sum-of-the-parts valuation adds $1.5 billion to $2.0 billion to Nebius's overall worth, solely based on the technological IP and testing history.
Next, we have 1010, the EdTech engine. Why would an AI infrastructure company hold on to an online coding bootcamp?
It serves two highly strategic purposes. First, it's a cash flow positive or near positive asset that diversifies the revenue base, meaning Nebius isn't purely dependent on cloud infrastructure. Second, and this is the deeper insight, it functions as a strategic talent pipeline for Nebius itself.
Ah, so it's their own farm system.
Exactly. In a hyper-competitive hiring environment, where AI and cloud engineers are the most sought-after and scarcest resource, having an internal university or bootcamp that trains talent specifically on the Nebius stack is an incredible strategic advantage, guaranteeing a continuous high-quality flow of fresh, qualified talent directly into the firm.
And finally, their strategic financial investment, the minority interest in ClickHouse.
ClickHouse is a hugely popular, high-performance open-source analytical database used widely by tech giants for massive data processing. Nebius holds a minority interest in the company, which was previously valued privately at $2 billion.
So what's the purpose of holding that?
The importance here is liquidity and optionality. This is a liquid financial asset that Nebius could monetize relatively easily if necessary. For instance, to fund an unexpected massive GPU purchase without tapping into their core operating cash flow. It's a multi-billion-dollar financial reserve sitting on the balance sheet. Chapter 6. Risk Assessment.
As Charlie Munger famously advised, invert, always invert. We have to dedicate serious time to the bear case. We must assess what could possibly derail this incredible thesis. What is the biggest, most persistent concern that keeps the short sellers betting against them?
It is the geopolitical stigma, or what the report accurately calls the Russian discount. Still, despite the radical, total legal separation and the Dutch domicile, lingering skepticism persists from large fund complexes, regulators, or ESG funds due to the Yandex lineage. The bear case argues that the stigma could limit the total addressable market, or TAM, especially if the company were banned from bidding on sensitive U.S. federal contracts, or if European regulators decided to impose extra scrutiny.
That is an existential threat if they are trying to scale globally. But the sources suggest strong mitigation against this persistent historical baggage.
The mitigation is strong, and it's why the company is trading at $90, not $10. The company is now Dutch domiciled, NASDAQ listed, audited by top Western firms, and governed by a Western board that proved its competency in crisis.
Right.
But the most powerful mitigation is the validation provided by commercial clients. Microsoft and Meta are global enterprises with infinite resources for due diligence. Their commitment of over $20 billion collectively validates that these sophisticated commercial counterparties have assessed and moved past the stigma.
So if it's good enough for Microsoft,
commercial acceptance is the best proof that the historical ties are severed.
the second major risk is concentration risk. Relying on Microsoft and Meta for the lion's share of their immediate contracted revenue is undeniably a double-edged sword. If one of those two giants were to strategically shift or cancel their contract, that creates a massive vacuum.
That risk is very real and must be weighed heavily. However, the structure of the contracts provides strong defense. First, these are 5-year framework contracts, which almost certainly include substantial multi-billion-dollar cancellation penalties, making exit expensive for the client.
Okay, that helps.
Second, and more practically, given the extreme global compute shortage, if Microsoft or Meta pulled capacity, Nebius could likely resell that capacity to another major AI customer. Think a competing foundation model builder, a large sovereign AI project, or an Amazon competitor very quickly.
The demand is just too high right now.
Asset stranding is currently a very low probability risk, due to the sheer supply-demand imbalance in high-end compute.
What about technological obsolescence? The risk that NVIDIA releases a new, far superior chip like the successor to Blackwell that accelerates the depreciation cycle of the existing H100 fleet.
This is a classic risk in high-performance computing, where technological cycles are fast. If a new chip offers 5x performance at the same price, the economic life of the existing fleet shortens dramatically.
Right.
However, the sources note that demand for existing chips remains robust. For instance, even older models like the A100s still have strong demand, especially for high-volume inference workloads where cost efficiency matters more than bleeding-edge training speed. The current H100 fleet is expected to have an economic life of 5 or more years, providing adequate time for depreciation and allowing the contracts to play out and generate massive cash flow before a forced upgrade is required.
Finally, we must look at execution on CapEx. Building the massive New Jersey site is a complex construction project, prone to delays, cost overruns, or permitting issues, burning cash without generating immediate revenue.
This is a risk tied directly to construction management. Building multi-megawatt hyperscale data centers is inherently difficult. However, management's 20-year history of successfully building and operating hyperscale infrastructure mitigates this risk.
They've done this before.
They are not novices. Furthermore, as we established, the company is fully funded. Even if there are 6 or 12 months of delay, it won't lead to a desperate need to dilute shareholders to finish the job, which is often the fatal flaw for less capitalized competitors. Chapter 7. Conclusion.
We have established the core business model, the management quality, the fortress balance sheet, and the massive contracted backlog. Let's summarize the core thesis. Nebius represents a rare asymmetry in the market.
That is the ultimate takeaway for the listener. This company offers the explosive, high-octane upside of a pure AI infrastructure play, a sector growing exponentially, combined with the immense downside protection of nearly $5 billion in liquid cash and pre-sold contracted revenue from two of the world's largest, most stable commercial clients.
So it's growth with a safety net.
It is a growth story that comes with a massive, unique margin of safety derived from corporate restructuring and scarcity.
Let's provide the detail behind the intrinsic value assessment laid out in the research, starting with the discounted cash flow or DCF model that supports that 33% upside.
The DCF model is robust because it is built upon the visible contract backlog, which reduces guesswork. The assumptions are key. Based on 2026 revenue ramping rapidly to $3.5 billion and assuming EBITDA margins mature to a utility like 35% by 2028.
Which seems reasonable.
It's a conservative estimate compared to highly utilized cloud platforms. And using a conservative 10% weighted average cost of capital, or WACC, the intrinsic value per share is calculated at approximately $145.
$145.
This confirms the initial hypothesis. The stock is trading significantly below its conservatively calculated fair value.
And the replacement cost analysis reinforces that margin of safety, showing you are buying the assets below their cost to recreate.
Absolutely. Think about the component costs. The time and cost required to successfully hire and retain 1,000 top engineers, the difficulty in procuring over $1 billion in current generation GPUs, and the critical 3 to 5 year lead time now required just to secure the power capacity and permits for sites like Vineland, New Jersey.
It would be almost impossible to replicate.
The analysis suggests that the current enterprise value is substantially below its replacement cost, providing a distinct, tangible margin of safety against the downside.
What about the sum of the parts, the SOTP analysis? How does that breakdown confirm the valuation?
The SOTP model provides another conservative check. Even using a low multiple of 6.0x revenue for the core AI cloud business, which is highly conservative when specialized peers like CoreWeave are often valued at 12x or higher.
Right.
And adding back the catch position, the value of Vorvreed, and the strategic investments, the analysis supports the current trading price. Crucially, applying a more realistic growth multiple, say 8x to 10x, to the core business would push the total equity value into the $30 billion to $40 billion range.
Which translates to what per share?
That translates directly to the $120 to $160 per share range, confirming that all valuation metrics point north of the current trading price.
So we have a clear, fundamental undervaluation driven by complexity. What is the final recommendation from the source material?
The market dislikes complexity in geopolitical history. And that fear is what is creating the current opportunity and the discount. But as the contracted, certain cash flows from Microsoft and Meta begin hitting the income statement throughout 2026, the complexity will fade and the fundamental strength will become undeniable.
The narrative will change.
The market will be forced to re-rate this company toward its infrastructure and growth peers. The final recommendation is clear. Accumulate NBIS in the $90 to $100 range as a long-term hold, aiming for a 3 to 5-year investment horizon based on the fundamental strength of its AI utility positioning.
That brings us to our final thought for you, the listener. Considering the painful, total corporate shift from operating primarily in Russia to successfully relaunching as a sophisticated, high-growth entity in Europe, Nebius' success isn't just about building data centers. It's proof that in the modern digital economy, technical talent, intellectual property, and strategic timing are far more portable, far more resilient, and ultimately more valuable than physical territory or even entrenched market history.
If you found this deep dive valuable and want to stay ahead of the market, remember to like and subscribe to Stock Analytics AI.
And for those who need access to the most powerful research library available, for $4.99 a month, get 500+ deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
This analysis is based on proprietary AI-driven research as of December 2, 2025, and is for informational purposes only.
This is not financial advice, and you should always conduct your own due diligence before making investment decisions.
We'll see you next time on The Deep Dive.